the sequence of return is basically telling you that, well, the returns you receive in the year when you first retire is going to matter most, as opposed to if you were not retired. For example, we had that study case we talked about in the book. If you are 40 years old and you're saving into an IRA or 401k, or you just have a brokerage account, it does not really matter what the market does. Because in that study that we did in the book, after 20 years or 30 years, and even if we invert the return you had at the beginning, and then we have portfolio right next to it, the average is going to be the same. And the outcome is going to be the same because you're not taking money out. You're not compounding any losses. So you have time. Not only you're not compounding any losses because you're not taking any funds out, number two, you have time to wait for the market to come back up. You had 10 years to wait, 20 years to wait. However, when you are 62, 63, you don't have the luxury of time. So when Wall Street tell you, hey, you know what, just wait, the market always come back. Hello and welcome to the Smart Business Owner Podcast with your host, Shubert. Hey everybody, welcome back to the show. This is Shubert with the Smart Business Owner Podcast. And this week, we have a guest that we had on the podcast before, Lydia. And today she's here to talk about my book. Usually people would see me with this book and they would be wondering, why does he have that book on the screen? And Lydia was one of our guests, and she wanted to find out more about the book. She had read the book, and she said, hey, I want to come on your podcast and ask some questions about the book. So Lydia is here today, Lydia Diliello. So Lydia, welcome back to the show, and can take it over from here.
Thank you, Shubert. Well, this is a great opportunity to flip the script a little bit and interview the gentleman who usually does the interviewing.
Yeah.
So I hope that your listeners are going to really enjoy this opportunity to understand your book and see you in a different light. And so I'm Lydia Diliello of Capital Pricing Consultants, and Shubert has been very gracious to give me the opportunity to interview him. So most of you know Shubert Cineus from Modern Edge Capital, but he is also an author, and the book that you see, which is called Secrets of Becoming Tax Efficient in Retirement and Creating Guaranteed Income for Life. So we're going to go through this book today, and I cannot recommend it highly enough. It is a marvelous resource to give you an overview of what you need to be looking at in retirement and also in preparing for retirement. So, Shubert, to start, what made you decide to write the book?
Well, great question. In order for me to give you a more comprehensive answer, I have to go back at the beginning as far as when it all started. So I started in this business about 8 years ago. And when I first started, I was working with a very large insurance company and broker-dealer. Northwestern Mutual is the name of the company I started with. And at that time, they're a very good company. And they, you get trained on how to help people create financial security for their family. But it was primarily insurance-based, that the thing that we're doing. But also we did some investment as well. But the thing is, what they have you doing, and I think pretty much any big company does the exact same thing. So they're using your natural market. So you would ask you, okay, well, who do you know in your natural market? So we had to make a list, and that list of all the people we know. And these are the people that we can call on to try to help them grow their business. Come to find out, I had about 200 and plus people that I know. Most of those people didn't do any business with me, even though that was the list that was supposedly going to help me. So the idea when you meet with those folks, even though they may not use your services, is to ask them for a referral. So who do they know that you can help with? Because you may not be able to help that person, but they may know somebody that you can help with these things. So asking those folks for a referral, say, hey, who do you know I can be able to help with those services, even though you may not need them, but we don't know if they do or do not need them. So asking those folks for the referrals, I run into a lot of challenges where they would be like, well, I don't think they would find value in it. Or this person is very successful. This person is a CEO of a major company. They look like they have everything together. So I don't think they're going to need anything. So that's that's the kind of pushback I was getting from those clients. And my response was that, well, I still want to meet them. I mean, if they're successful, I want to meet them and get to know them a little bit and learn about their success, because success leaves clues. So if I can just talk to them, maybe I'll learn something. So with my persistence, they still refer me to some of those folks. And come to find out, Lydia, and I'm not kidding you, those folks that these people thought that they were all taken care of, they had everything, all I's dotted, all T's crossed. They needed my help the most. They needed my help more than the people that referred me to them. Because a lot of time we're looking at things on a bird's eye point of view, or looking at somebody and say, okay, well, that person got to know about how taxes work in retirement. They got to know about, all those different fees and taxes, how to get everything situated. Most of them, if not all of them, have no idea how these things work. And even if they have the background, sometimes I work with people in the financial industry, as far as CPAs, that know a little bit about how to navigate these things. However, they don't have the time. They are busy running the business, busy helping other people, and they don't have the time to either educate themselves or to taking care of these things. So I keep running into this problem over and over and over, where folks have no idea how these things work. And I say, hey, there must be a better way for me to be able to educate, helping those folks overcome this huge problem, which is taxes is one of the biggest things. So that's why I say, hey, you know what? What if I can put that information into a book, and people can have easy access to it? It's relatively very inexpensive to get. And even if they don't speak with me, even if they don't have a meeting with me or work with me, they can go back and just read the book. It's available on Amazon. You get the book very inexpensive. You don't have to write the book. And that's how the secrets of becoming tax efficient in retirement and creating guaranteed income for life was born. I know it's a long-winded answer, but I had to give you a background.
Well, I appreciate the background, and I was taking a couple of notes, Shubert, because you said a couple of things that really rang true with me. And the first is you said, well, success leaves clues.
It does.
And so I think that it was great that you were persistent about pursuing people who have been successful, because to your point, they are often so busy making the money and putting it away that then they lose all opportunity to spend time on the what, the why, the how around those finances. And
Yes.
with your book, because you have arranged it in a very methodical perspective, it builds on itself, and you break down all of the different financial modalities like annuities, and then explaining what each kind of annuity does and why it does that. And we'll get into those details later in the conversation, but giving people context for, hey, have you thought about your retirement? Do you know that you better check not only your Social Security, which is a guaranteed income, but what about, how do you protect against if the market changes? And does the 4% rule really apply?
Right.
And a lot of concepts that people could just take the book and go back in either the very front pages that show the overall overview in the contents, or they can just go to the back of the book and say, hey, wait a minute, I want to look at a guaranteed fixed annuity, and what does that mean to me?
Right.
So I think it's a wonderful tool, regardless of where someone is in their career, honestly, because starting to be aware and plan for retirement early, I think, is so important. And so that leads me kind of to the next section is, so who is an ideal client to you, or who do you think would benefit the most from reading this book, and why?
Great question. Now, before I answer that question, there's one thing I want to talk about. So the other reason that I wrote the book is that most people get their information from the media. they would look at the business channel, let's just say CNBC, or they would watch the news, and they would take snippets of about a topic, and then they say, okay, well, I watched something on this channel, on that channel, and that's what I'm going to do. And that could not be further from the truth, because fact of the matter is, when these people are reporting the news, they're telling you about something. They're not expert on these topics. That's number one. Number two, they are limited on time. They want to just catch attention, because the thing about the media, they're all about catching attention. They're not about helping people. So I say, hey, you know what? A lot of time I keep, people would tell me, oh, these tools, I heard that this tool is bad, or this financial tool is bad. I'm like, where did you hear that? I mean, how do you know? But I saw that on the media. I said, okay, great. I saw that on CNBC. I said, okay, great. So that was the other reason why I wrote the book. So who can benefit from reading that book? The title of the book, if you're looking at just the title, you would say, well, somebody in their 50s, pre-retirees or retirees would benefit greatly, because it's called The Secrets of Becoming Tax Efficient in Retirement and Creating Guaranteed Income for Life. So people that are pre-retirees and retirees would be the number one people that can benefit, number one demographic that can benefit from the book. Number two, the way I wrote the book, I had everybody in mind, because it's not just the pre-retirees that need the help. I think everyone in America need the help, because they don't teach, if you didn't go to finance school, most colleges, they don't teach you anything about how balance sheet work, how a profit and loss statement work, how credit card debt work. They don't teach you anything about finances. So what I did was I went into every single thing. I put myself in the shoes of somebody that is not working in finance and don't know about these topics. And I said, okay, what would I want to know? So pretty much everything. So what I did was I put all the information I think somebody need to know that's going to help them make better financial decisions. They don't have to be in retirement in order to find value in the book. They can read the book and still educate themselves. And if they do that, let's just say if they are in their 30s and they are getting access to that information, by the time they are in their 50s, they're going to be head and shoulder above their peers. And because the reason is very simple, is because they're going to understand the value of starting early, because a lot of times we're like, okay, we have time, as opposed to they take one of the best commodities they have, they don't use it, which is time, especially when they're young. So anybody can benefit from reading the book, pre-retirees in particular, but somebody's young, the young folks will find tremendous amount of value out of the book as well.
And you make a great point, Shubert, about making sure that people, as they age, right, because time is the most precious thing we have, that they're utilizing it to help leverage that retirement early, because you don't get those years back. So if they're educated already in their 40s, then to your point, they're going to be so much better prepared in their 50s to understand the information and really put it to use.
Yeah. I'll give you an example. I'll give you real quick. I'll give you an example.
Please. No, please.
I sometimes I would meet folks that are just retiring. You could just say, like, I have a specific case. I'm not going to get into the details, but I can give you the Cliff Notes. The person retired at 63, and by the time I met them, they already made the decisions to start taking Social Security benefits, and they just retiring. And they used to own a business. They sold the business, and then they say, okay, well, I'm ready to retire. So I went ahead, do an income plan for that person, with no charge, and come to find out, even though they think that they are retiring, the lifestyle they wanted to live, the thing that they wanted to happen, the amount of income they wanted to receive, the asset was not going to support that. And that particular case, looking at $1.5 million they had in savings. Now, you would think that somebody that is a millionaire, not, like a million, just, because if you own $1 million, you lose a little bit of it, you're not a millionaire anymore. $1.5 million in savings. And I had to go back and tell them, look, if you want this type of lifestyle, and this is the type of income you want, it's not going to support that. we had to make some adjustment, either go back to work or adjust the lifestyle that you wanna see happen. And had I had met with that person earlier before they retire, I could have said, hey, this is what you want, this is what's coming. So we could have made those adjustments 5 years ago, 5 years before they retire, or 10 years before they retire. So when the time they finally pull the trigger, say, hey, I want to become financially independent, because sometimes I don't even use the term retire, because especially when I'm working with folks like physicians, attorneys, just folks that love to work and they feel like it's a calling for them, and they say, as long as my brain's working, I want to continue to do what I want to do, but I want to become financially independent, where I can go to work when I want to, not because I have to. So even those folks, so if I can get with them early before they get there, it's easier to accomplish what they are looking to accomplish, if that makes sense.
It's a wonderful example, Shubert, and I've already picked up a couple of lessons or rules, if you will, from our discussion so far. The first of which is start to get yourself educated, which is really what this book does. It gives you a baseline that's very clear, no nonsense, not a lot of jargon to use as a resource to say, let me read a little bit about this so I can ask good questions of my financial professional. And then the second thing is, I need to be having those conversations continually and not go make decisions and then go back and have the conversations, because then it's too late. And I'm sure for those folks with 1.5 million, most of us would think, hey, I can pretty much do what I want in retirement.
Yeah.
And in fact, they couldn't. And I suspect that what they were wanting to do wasn't extravagant. It was simply that the money, especially when you retire at 63, now that we all live so much longer, and you talk about that in the book, about the longevity
Yeah.
risk and what that means. And you talk about things like long-term care and how that can impact our retirements. But it's so important to be having these conversations sooner rather than later, so that we can prepare and make choices rather than just have it happen to us. And I also think it's a great piece of advice for people who say, yeah, but I love what I do, I'm not going to retire. Well, okay, but if you are financially independent, then no matter what you choose to do, you have yourself and your family covered. So let's talk a little bit, Shubert, about there's a common perception, and I've heard it among my friends that have retired, about the 4% rule. Tell us about that a little bit, and your thoughts on
Yeah.
it.
So the 4%, well, I think it's one of the case study we talked about in the book. So the 4% rule, it's a rule that is archaic. So I want to start with that. It's been around
Okay.
for a long time, and even though we talked about it in the book, this is not
Mm-hmm.
something that we recommend, and I'm going to explain to you why. But before I do
Good.
that, let me explain what the 4% rule is. So the 4%
Okay.
rule, after you know, before be, before 19, I think it was 1978. We used to have uh, pension. Most people in America,
Mm-hmm.
you work for a company 25, 30 years, they will give you a pension. And that pension will be able to sustain you with Social Security. You'll be able to rely on that pension for the rest of your life. Now, when they got rid of pension and it came up with Social Security, so they've come to realize that, well, some people will end up with more money, some people will end up with less. It all depends how much they put into their 401ks. So what Wall Street does, they say, okay, well, we need to find a way to tell people what to do in order to be able to retire as if they had a pension. So that's how they come up to say, well, if you can save $1 million into an account, and if it's invested, according to your risk profile, the risk you're willing to take, if you take 4%, you probably gonna be able to have that money last you for as long as you live, basically your lifetime. If you retire at 65, that money probably gonna last you 35 years if you take 4%. However,
A year.
a year. However, in the
Okay.
1970s, interest rate was very high. Inflation was high, but interest rate was, unusually high. So when they had those rules, let's just say, for example, those 4% rules, it was based on a portfolio. They had those, they still do, they have these things, 60-40, 70-30, which is 60% stocks, 40% bond, or target date funds where they have a mixture of equities or stocks and bonds. However, bonds used to earn a higher rate of return. The interest rate was significantly a lot higher. So if you're receiving 4%, you're taking 4% on your portfolio, you have a good chance that money can last you for as long as you live. However, the other reason they did that is because securities or stocks have an inverse relationship to bonds, meaning that when stocks going up, bond tends to go down. When stocks going down, bonds tends to go up. However, that inverse relationship failed in 2022 because I don't have the slide here. I could show you. Bonds and stocks went down in the same year by a significant amount. Stock was down 22% and bond was down significantly in the same year. That's not supposed to happen because the whole idea of the 60-40 or mixture of bonds and stocks is telling people, hey, that money can last you for a long time. And not to even mention inflations. So the 4% rule used to work very well in the 1970s. But with the way things are these days, whereas we see that bonds and stocks can go down together in the same year, we find that the 4% rule is unsustainable. So instead of using those off-the-shelf strategies that Wall Street is still recommending, if you go to any big firm on Wall Street, that's what they're pushing. You're pushing your portfolio, they put a 60-40. And the idea is they don't have the time to deal with every single client they have because they're all about big numbers. So they have all of those shelf strategy, which is archaic, in my opinion. And that's what they're pushing on everybody. And that's the 4% rule, which is been using technology of the past in the future today.
Well, and you talk about that in the book as well, and you talk about the idea of what you just explained in 2022, where we had that very odd situation where bonds and stocks both went down. And you also talk about when you retire, you can't make up for a market correction or a market fluctuation, and you cannot change the timing. So you have to safeguard yourself against that. And you gave a great example in the book about two people who retire, same amount of money, same conditions.
Yep.
One has a timing issue that's not good. So can you talk a little bit about that? Because I think oftentimes we go in with certain assumptions about retirement, like the 4% rule. Like if I have more than $1 million, of course I'm going to be safe. Like, well, the stock market always makes it up over a certain amount of time. So can you talk about that example a little bit, please?
Of course. So that's the other flaw with the 4% rule. And it's one of the biggest risks. We call it a retirement killer. And basically what it is sequence of return. So sequence of return, the way to happen, let's just say you have, somebody put you in the 4% rule, say, hey, you have $1.5 million, take 4%, you're going to be fine. Let's just say, for example, I'm just going to give you a real example, a real life example. You retire in 1990. If you retire in 1990, we had a lot of great years in the 90s, so you're probably going to see a lot of growth in the early retirement years. You might have some negative growth along the way, but you're going to be just fine if you retire in the 1990s and you had a 1.5, let's just say, call it $1 million in your portfolio taking 4%. However, if you retire in the year 2000, it could be a totally different story. Because in the year 2000, we have a lot of bad years in the early of that decade. And if you had that can significantly degrade your funds while you're taking 4% out of it. Here's what I mean by that. Let me get into more details. The sequence of return is basically telling you that, well, the returns you receive in the year when you first retire is going to matter most as opposed to if you are not retired. For example, we had that study case we talked about in the book. If you are 40 years old and you're saving into an IRA or 401k, or you just have a brokerage account, it does not really matter what the market does. Because in that study that we did in the book, after 20 years or 30 years, and even if we invert the return you had at the beginning, and then we have portfolio right next to it, the average is going to be the same. And the outcome is going to be the same because you're not taking money out. You're not compounding any losses. So you have time. Not only you're not compounding any losses because you're not taking any funds out. Number two, you have time to wait for the market to come back up. You had 10 years to wait, 20 years to wait. However, when you are 62, 63, you don't have the luxury of time. So when Wall Street tell you, hey, you know what, just wait, the market always come back up. You're 62, you need money, or you're 65, you need money to pay your bills and live your lifestyle. Go to Europe, making the trip, treating your grandkids. So here you are, you have 1.4 million, and you're just taking 4%. Let's just say, for example, you retire this year, where we have a lot of negative things happen in the market, and you're taking money out. Let's just say you're taking your 4% out. It's gonna affect you negatively. In the example that we show in the book, if you retire in the year 2000, there's a good chance that you're gonna run out of money. And the reason is simple: you're compounding your losses. Let's just say you're taking 4% and the market is down 10%. That's 14% you take out. And the problem with that is that if your account, I'm just going to give you a round example so you can understand it better. If your account goes down by 10%, it needs to go up by more than 10% the following year in order for you to just get back to break even. So
it essentially has to go up by 20%, Shubert. I remember you saying that in a previous conversation. It has to go up by more than double.
Every percentage has, for example, if it goes down by 10%, it needs to go by 11.1% the next year. If it goes down by 25%, it needs to go up by 33.3%. Now, if it goes down by 50%, which very well can happen, if you have a drawdown of 50%, then your account have to go up by 100% just to get back to break even the following year. Now, the question I usually ask clients, and the answer
it doesn't happen.
Just shake your head. It just never happened. So if you are 62 and you have all your funds invested with a financial advisor, you're paying that advisor 1% or 1.5%, whatever the fees are, and you have all your money in the market, and you're using the 60-40 or a balance account 50-50, you're taking risk that you cannot afford to take, because what's going to happen is what happened in 2022 is going to repeat itself. And that's the thing about history. It tends to repeat itself. Things doesn't happen on an island. They don't happen one time and never happen again. So you have to make sure that sequence of return risk is being taken care of. You need to make sure that, and I'll tell you, very simply, this is not financial advice. I encourage everybody to talk to the financial advisor about these things. However, you need to have predictable inside of the portfolio. You need to have some guarantees. So you cannot rely on Wall Street or 100% of Wall Street to create your income in retirement. You need to have some guarantees within your portfolio, and that's how you can overcome sequence of return risk. And it's like I said, this is the biggest risk every single retirees will be facing in retirement.
Well, and the point about Shubert, how much you have to make up each time there is a loss. And we've seen so much volatility in the last, let's say, 12 to 18 months.
Right.
In the overall stock markets. There have been some tremendous gains, but there have also been some very significant overall losses. And staying ahead of that and having a balanced plan that allows you to make up for that. Because again, I want to go back to the point you made about due to the sequence of returns, you can more than double your loss, if you will, just by taking that 4%, because now you add that 4% to whatever amount the market is down.
Right.
So in a bad year, the market's down 7%, 7 plus 4 is now 11.
Right.
So your portfolio is down 11%. And then to make up that 11% the next year, you're going to need a tremendous gain, which is very
13.5%. And if the market is down, 22%, and then you take the 4%, that's 26%. So you need to be up by 33 point and change. So it's very easy.
And the book does a great job of going through that in detail and showing it line item by line item, which I think is very helpful for folks. So ways to help mitigate that. Are annuities, you talk a lot about annuities in the book. Are annuities a way to, and this is not financial advice, but just talking about balance and some of the things you highlighted in the book and tools available to people for investing. Is an annuity a way to help with that because it's a guaranteed stream of income?
So great question. And usually when you turn on the media, turn on the news, they usually say annuity is bad. Annuities are bad. Still, I would speak with folks and they would say, oh, I heard that annuities are bad. Stay away from annuities. And when I hear that, I usually smile and laugh or laugh. And I ask him, what did you hear that? Oh, I read that somewhere on the online. I heard that on the media. The fact of the matter is, to answer your question directly, yes, annuity can be a tool, not the only tool. It can be a tool you can use to neutralize that sequence of return risk. And here's why. Annuities, it depends on the cycle or the time it's being purchased. And that's going to make a big difference as far as what kind of features you have inside of that annuity. For example, if you buy an annuity during low interest rate, let's just say, for example, 2015 to 2020, interest rate was super, super low. So if you had an annuity during that time that you had to buy it, you can easily refinance your annuity, replace it by another one that have better features these days. But the media has categorized, just put a bad name and said, this is bad, this is generalized, this is bad, stay away from that. And that could not be further from the truth. The reason is very simple. If you know what questions to ask your financial advisor when you speak with your financial advisor, what to look for, annuity can be a fantastic tool to help you overcome sequence of return. Now, that's not the only tool, but that's one of the tools you can use to help you overcome that. And when you're looking at what annuity does in a financial plan, it gives you something called guarantees. A lot of time, people are saying, okay, well, anything that's giving you guarantees, I don't know if I can rely on that, because who can give guarantees? Just like your Social Security, for example. Your Social Security is a guaranteed income it gives you for the rest of your life. Annuity does the same thing. And even those folk that says annuities are bad, they're all taking Social Security, which is an annuity. But the difference between Social Security and annuity is that Social Security is managed by the government. And annuity is managed by a private company. And most of the time, those private companies, we only use A-rated companies for those things, meaning that companies that have a solid balance sheet and have the ability to pay these things. However, can we really rely on the government to pay for Social Security? Because the last time I checked, it's projected to be running out of money in 2033 because the funds are not being managed the way it's supposed to. Congress needs to do something in order to prevent that from happening. But basically, to explain to folks, annuity can be a fantastic tool to help them overcome sequence of return because it gives them a guarantee. Now, I'm not recommending the folks to go ahead and buy an annuity without knowing what you're doing. That's why I put these things in the book. Some of the things that you need to ask your financial advisor as far as before you go ahead and sign up for an annuity. So I spoke about that in the book. I'll give you a couple of examples here. The first thing is front load. For example, are there any front load fees? The front load fees is basically let's just say, for example, you buy an annuity for $100,000 and there's a front load fee of 4.5%. That's $4,500. You don't want that, meaning that your $100,000 is not going to be $100,000 right off the bat. That would be a bad annuity. Are there any annual fees? A lot of time you would buy the product, but there's an ongoing fee, just like your financial advisor sometimes charge you 1.5%, for advice. Some annuities, they have those fees on an annual basis. So these are some of the things that I put in the book to help people understand these things, because if you know these things, if you know the questions to ask, this is a fantastic tool you can use to help you have your best retirement. If you don't know how to about those things to ask, then you can get hurt. Just like, for example, a knife can be used to prepare a good meal for a family in the hands of somebody that knows what they're doing. In the hands of a criminal, it can be used to do devastating things. Does that mean the knife is bad? No. It depends on who's using it and how you're using it.
And that's a great example, Shubert. And I want to go back to the point you made relative to a front load annuity, because I think that's often where the media jumps on board, and they're not wrong in saying, hey, this is awful. You took $100,000, you pay a 4.5% front load fee, and now you're down to 94.5
Right.
for your investment, right? Or sorry, 95.5. And 100 just went to 95.5. And then on top of it, you're going to pay probably an annual fee of 1%. So your investment, instead of gaining money, is eroding year after year. Who wants that?
Nobody.
So to your point, right? We all need to read and understand so that when we talk with our advisors and we hear things like front load, we say, no, thanks.
Right.
Or what we know to ask, hey, what's the annual fee on that? In addition to the advisor's annual fee or transaction fee, so that we're being educated. So definitely annuities is a huge set of tools that can be utilized. There's other things too that you talk about in the book in terms of retirement risk. And one of the ones that I noted, because you talk about danger of longevity, interest rate risk, higher taxes, and stock market risk. Can you give us an example, Shubert, where higher taxes, because I think a lot of people don't realize that their actions can throw them into a higher tax bracket. They just assume, hey, I'm retired, so if I take my funds or they're just out doing their thing,
Right.
and not realizing they could inadvertently have just given themselves a nasty surprise. So will you speak to that for a minute?
Yeah, of course. Sometimes I find it interesting and funny at the same time. I would see folks online or on YouTube, and they say, they say that, oh, I thought my 401k, if I waited till after I'm 59 and a half, there's no taxes. And I think, it was somebody really famous that actually that was on YouTube talking about that. And the host had to correct that person, say, no, it's you're not going to have any penalty, because the thing about those retirement accounts, which I'm not against, retirement accounts. So people need to understand how these things work. And that's why I wrote the book. Again, I put that information is there for them to, to read it. So let's talk about the first risk you talk about, longevity risk. Longevity risk is a risk we started having as we have more medical breakthrough, where, back in the day, you fall down, you break your hips, it's a death sentence. Maybe you have a year and a half to live off. After that, you're gone. Or, most of the time you retire, and people would live maybe 5 years in retirement. You retire 65, you expire 70, and that's it. You don't have to worry about it. So if you had $1 million, you're just taking 10% or 4%, you're going to be just fine. You only have a lifetime of 5 more years to live off. This is no longer the case, because people are living longer than they did working now. Some people are living 30 years in retirement. If you take, somebody that, retire at 65 and live up to 95, that's 30 years. Some other people even beat that. Some people live 100. That's 35 years. So if you have, your assets, let's just say you didn't maximize, your savings, and then you get to retirement and you have the bare minimum, you're going to have a problem with longevity, because the longer you live, the more money you're going to need to live off. And as you get older, just like a machine or a car, things tend to break down. You tend to go to the doctor more often. You become more fragile. And as that happens, that's when you have another risk added on top of it, which is, okay, well, how are we going to pay those costs? We have a hip replacement. We need our aide to come to the house. Who's going to pay for that? That's not covered. A lot of people say, oh, I have Medicare. Medicare will pay for it. Well, no, Medicare is not going to pay for that. They only pay for the first 100 days. After the first 100 days, it's on you. Well, my insurance will pay for that. Well, no, insurance company don't pay for long-term care. This is something totally separate. So you have, to make sure that you have that into place before you get there. And the other thing that a lot of people don't know, if you have a business, the cost of long-term care can be a tax credit. It can be used as a tax credit. Not the whole thing. The older you get, the more tax credit, the more you can write off from the cost of the premium. And that's the second risk in retirement. The third risk is, we talked about that, sequence of return risk. Like I said, this one is a killer, because you don't know. If anybody tells you that they know what the market's going to do, they're lying to you, because nobody knows if the market is going to be up, down, sideways. So we don't know what the return is going to be in the market, if we're going to have good years or bad years. Because of that reason, you have to make sure, as I said originally, that you have some guarantees inside of your portfolio. So Social Security is going to be a small guarantee you have inside of your retirement income. So there's going to be a gap between what you're receiving from Social Security and what you really need on a monthly basis to live your life. That gap, it needs to be accounted for. You need to find a ways to bridge that gap. As I said, annuity is not the only thing you can use, but that's one of the tools you can use. You can use cash for that. You can use different sorts of income. And the last one is, you're looking at longevity. You're looking at long-term care. You're looking at the stock market. And the fourth is, interest rate. For example, right now we have interest rate unusually very high now, even though the current administration is going after the Fed chair to lower rates, which I think is going to happen at some. Let's just say, for example, if you have your funds in a CDs, for example, and you're earning 3%, 4%, when interest rate is lower, you're going to be earning a lower rate of return on that CD that you were receiving. If you had, let's just say, if you were into treasuries, if you had bonds, they're going to cut down those interest rates, once the Fed lowered interest rates. So that's a risk that you have no control over. You don't control what the Fed does, and when interest rate is high, when interest rate is lower, because sometimes they have to lower it because of the economy. Sometimes they have to raise it because of what's going on in the economy. You have to account for all those risks you have in your retirement. And because of those reasons, if you just have what most people have, which is the hope plan, because another thing that I've seen, if people think that, well, if my neighbor is doing the same thing, if I do the same thing, I'm just going to be fine. I hope everything's going to be fine. Sometimes you have the hope plan. They follow the crowd, follow the herd. That could not be further from the truth, because if you are just hoping everything's going to be fine, well, I have news for you. It's not good news, because it's not going to be fine.
No, and as we know, herd mentality, sheep get slaughtered. So just following the person in front of you does not make sense. But you do talk about in the book, Shubert, that what we do have control over is meeting with our financial advisors and updating that the portfolio is not static for the very reasons you just mentioned, because as all of those risks morph and change over time depending upon the economy, the administration in place, uh, from a political perspective, in terms of new investment options, in terms of our own lifestyles, all of these factors change. And so we should constantly be meeting with our advisors to adjust our portfolios. How often do you suggest meeting with a client to make sure that their retirement portfolio is doing what it needs to support them?
Usually, every quarter, every 3 months is usually a good time frame. However, you need to make sure that your advisor is doing comprehensive planning for you as well, because sometimes if you're speaking with a wirehouse advisors, they put everything in the market. They're all about, hey, let's just swing for the fences. But we know that doesn't work, because we saw what happened when you swing for the fences and then you put all your money in the market. If you're talking with an insurance advisor, they're all about every insurance they can treat everything. Everything is either you need a whole life policy or you need an annuity. So this as well is not good, because it's kind of like the old saying, everything looks like a nail with a man with a hammer. If you have a hammer, everything looks like a nail. So it's very important that folks have an advisor that can not only specialize in retirement planning, and that's something that we do. We are specializing in working with pre-retirees and retirees. And the reason is simple. They need the help the most. And because at that time, they cannot afford to have any mistakes happen, bad planning, bad advices. And they don't have the luxury of time to wait for the market to come back up. So they need to make sure that what they have saved lasts them for as long as they live. And also they have a plan that's going to dictate how that's going to happen. And we can also always adjust things as things goes, but these are very important things for folks to know when they meet with a financial advisor. And these things, I spoke about them in the book again. Folks can just read the book, and when they can go speak with the financial advisor, not only they're gonna sound a lot smarter, but the financial advisor is gonna have eyebrows raised. Oh, I had no idea. How do you know that? Well, it's right here. It's right here.
Exactly. So Shubert, kind of as we wrap up our conversation here on the secrets of becoming tax efficient and creating guaranteed income in retirement, is there any parting thoughts or words or anything else you'd like to share with the viewers that you have not shared so far? Any final words of wisdom?
So the first thing I would say to folks is educate yourself. I don't want to sound religious or anything like this, although I am a believer. But the scripture says, my people perish because of lack of knowledge. And what I said is that folks will fall victim if they don't educate themselves, if they don't acquire the knowledge they have. And when I'm talking about knowledge, I'm not talking about general knowledge. Let's just say you're a lawyer, you have legal knowledge about the law. That's not what I'm talking about. I'm talking about the knowledge you need to know when it comes to retirement planning, your asset that you spend your lifetime saving. So you need to educate yourself. So acquire the book and read it. And it's a very fast read. That's not going to take you a whole bunch of time to read it.
It is.
And it's very condensed for a specific reason, because if we make it 500 page, 600 page, people are going to say, oh my goodness, this is too long. I can't read that. But
nobody's reading that.
I wrote the book as if I was speaking to a 5-year-old. So if I'm speaking with a 5-year-old, I can just read the book and they will understand it. That's how much I break down those jargon, those complex terms that Wall Street love to flow around. So I'll break them down in terms that people can understand and put them in the book. So the first thing is educate yourself. The second thing is, don't just read something online and think that, well, this is bad, this is not good, I'm good to go, I know what I'm doing, I'm going to do everything myself. Because some folks will hear that podcast and they can say, okay, well, let me go ahead. I'm going to read a few things online, and then I'm going to be good to go. And that would not be the best decisions. And the reason is simple. Yeah, if just reading something or getting the knowledge was enough, everybody would be fit, everybody would be good looking, because all that information, we live in an era where you can just go on, chat GPT or on Google, you have access to all the information. However, how to implement that information, that specialized knowledge matters. However, by educating yourself, when you have somebody helping you, you'll be able to ask the right questions and being able to make the right decisions for yourself. Being able to say, okay, is this a good, and just for the, if we are to use the annuity as an example, is this a good annuity, or is this a bad annuity? Because we talk about that in the book, how to recognize the good ones from the bad ones. And the third thing is, don't watch this podcast or don't read the book and say, okay, well, I'll get to it. Because a lot of times what people will say, well, I don't have time. I'm busy right now. I don't have time to do it. I'll have time to do it. And one thing I'll tell you, time flies very, very fast. That's number one. Number two, you do not want to wait till the last minute to try to do something, because a lot of time it's not done fair. It's not done correctly. So it's better to start when you don't need to start and have plenty of time to make adjustments as you go along, as opposed to wait at the last minute to say, hey, let me call my financial advisor, because I've seen that podcast guys talking about guaranteed income. How do I get that? And how do I get the right one? Because I'm not recommending the folks to just go ahead and then buy something and then not recognizing if it's a good decision or if it's a bad decision. So you need to educate yourself, and you need to make sure that you get the help that you need. And one thing that I haven't talked about, and that's very important, is that when people save, and that's one of the questions, I don't think I answered that question, was some people tend to not diversify properly. And here's what I mean by that. I've seen folks, they work for a company and they put all their money in a 401k. And they say, well, I have $1.5 million in a 401k, or I have $1 million in 401k. That looks pretty good. But the biggest problem with that is that they don't really have $1 million. And the reason they don't have $1 million, because that money, all that money doesn't belong to them. A portion of that money belongs to Uncle Sam. It's just, if they are in a 30% tax bracket, instead of having $1 million, they really have, in reality, $700,000. So one thing I said to folks, do not put all your funds in a taxable account. Because if you put all your funds in a taxable account, when it's time for you to take that money out, you are saving that money for you and Uncle Sam. And if you, and there are certain states, if you live in those states, we're talking about 30%. Some other states, they have taxes as high as 40% and 50%. So here you are, you save $1 million. Hey, by the way, you don't have $1 million, you have 500,000. If you live in a state like, people know what those states are. I don't need to name the states, but do not put all your funds. And again, I don't want folks to say, hey, he said, don't put money. That's what the media does sometimes. They would take a snippet and say, oh, he said, don't put money inside of this particular account. And that's not what I'm saying. What I'm saying is you have to have a plan. You cannot have all your money in a taxable account, because if you do, you only have 70% of that money or 50% of that money. You want to make sure that you have tax-free money, tax-deferred money, which is the 401k, and tax-deductible money. It's going to help you on a year-by-year basis. So not one tool is bad. You have to have, it's just kind of like a plumber. You have to have different tools to help you do the work that needs to be done.
So in summary, Shubert, what I hear you saying is, don't procrastinate. No matter where you're at in life, get educated and go start meeting with a financial professional, and don't put it off because you can't make up the time. And make sure that you are asking good questions, and that you are not the old, don't put all your eggs in one basket. Find multiple baskets so that you are protecting yourself against tax eventualities, and then have conversations about the things in life that have changed for all of us, which is longevity and long-term care, and what do all of those things mean, potentially life insurance, so that it's totally balanced. Because at the end, what you're looking for really is the old balancing seesaws that kids used to play on, right? You don't want to be, if you're really up, well, that's fantastic, but as fast as you went up, you can go right back down again.
Yes.
And so what we want is a nice level, steady state that we can trust and count on for a long-term enjoyable retirement.
Yeah.
So if folks want to reach you, Shubert, at Modern Edge Capital, what phone number can they call to reach you directly?
Well, they can call me, my cell phone directly. We'll put that on the screen for them. And
Perfect. Let's do that.
they can go to modernedgecapital.com, modernedgecapitalllc.com. They can book a meeting directly on the website. And the meeting is a free meeting. It doesn't cost them anything. And the first meeting is usually, 100% free. And if they qualify, we can even create an income plan for them at no extra cost. And the reason we do that, we want folks to have access to that information, because a lot of time you would find firm, they have so many barriers to entry. It's almost impossible for folks to have access to that information. We want to make sure that we remove those barriers and give folks access to comprehensive planning, and whenever they're ready to get things moving in the right directions, and we'll be there to help them.
Terrific. Well, Shubert, it has been a pleasure to have the opportunity to interview you on your podcast. Thank you so much. And once again, folks, please do go out to Amazon and pick up a copy. You will be very happy that you did. The Secrets of Retiring Tax Efficient in Retirement and Creating Guaranteed Income for Life by Shubert Cineus. Thank you again, Shubert. It was a pleasure.
Yes, it was a pleasure. Thank you for doing that. I've never... That's the first time I was interviewed on my podcast about the book. We get some really good feedback, from folks that have read the book. But it's the first time that we had somebody on the book that have read the book and come on the podcast and ask questions about it. And again, thank you for doing that. And I hope folks,
my pleasure,
you'll learn a ton about some of the things that we shared today, because I never really spoke about the book during the podcast. So the first time we're doing that. And I hope folks learn a ton. And I hope you don't just listen to that podcast and say, okay, I hope everything's going to be fine. And you actually go back and put that information to use. Good use. All right, folks. Well, that's all we have for this week. We'll see you on the next episode. You've been listening to the Smart Business Owner Podcast. See you in the next episode.